Well, we just have a few minutes to do questions, but before we get into that, I wanted to talk just very briefly about my own investment in this fund. I started in February 2020 with a $100,000 investment. I think that was the minimum at that time. And so and I'm in the DRIP program like most of the investors. So I just reinvest all of my dividends. And I think I've got something like $134,000 in there now. But I just got my K1 for this fund well before the April 15th deadline, I might add. And it showed that I got about a little over $7,000 in distributions last year. And of that, only less than a quarter of it was actually taxable income. It was $113 in interest, $154 in ordinary dividends, $65 in qualified dividends, and a little over $1,100 as a short-term capital gain. So that's pretty darn tax efficient for a fund that's focused so much on income, that has so much preferred equity in it. Is there anything you expect to change with the fund that might make it significantly less tax efficient than it has been?
Jim, a good question. And, as we think about tax efficiency, certainly that's a secondary goal. You never want to let the tail wag the dog. So as we started tilting the portfolio more and more into preferred equity, it's going to reduce the tax efficiency. So if we go back to even 2021, I believe we returned 94% of the distributions came back tax-free. So this is a little less. So the more the portfolio is tilted towards preferred equity, it's not going to be tax inefficient, but it's going to be less tax efficient. So I think what you just described is probably the least tax efficient. And the way that we structure our preferred equity deals is a little bit unique because it's a common equity position that has preferred equity rights. So common equity is subordinated to us, but we actually don't have maturity. And that's one of the things that gives us an advantage in the market with some of these sponsors. And candidly, I mean, there are put rights and things like that, and there's triggers that we have if they don't meet certain goals. But we have a deal in this fund, you probably know it, Lively, where the sponsor has built the deals. They pay a 13% interest rate. That's accrual. They perform incredible on their development, and now our positions are sitting there at 58 to 60% on a loan to value basis, and we're accruing 13%. So, like those things. But when those mature and they pay those off, we will actually get long-term capital gains because of the way those are structured. So if we were true preferred equity or true mezzanine debt, that would be taxed very differently. So we try to find creative structures that work well from the tax efficiency, and it's something we think about constantly.
The hosts of the YQA Investor Podcast are not licensed accountants, attorneys, or financial advisors. This podcast is free entertainment and information only. It should not be considered professional or personalized financial advice. You should consult the appropriate professional for specific advice relating to your situation.